that's entering the lexicon, and that means he gradually slows it down. And if we get a 250 run Friday, that means we are 2 months into that 6 months of ending QE. So, of course, end of QE basically means end of market, and basically going 100% to the short side instead of the little 20-30% shorts that I'm running here. Okay, let's see. Today's ADP, really reliable. And for disappointing NFP on Friday, that's right. That could be another reason why the market is flatlining this week. Okay, moving on. You know, I like this Goldilocks picture so much, I thought I'd put two of them up there. But, you know, I just thought I'd outline the ultra bull case for the economy, which virtually no one is discounting into the market, but seems to be unfolding. At least those are what the numbers say. And the bull case has Q1 GDP coming in at over 3.5%. That's a huge number. The housing recovery spills over to the rest of the economy, adds another 1% to GDP. Durable goods keep strong, and falling unemployment basically bolster this view. A big stock market wealth effect is kicking in. Debt ceiling, sequestration, and the budget crisis have had zero impact. No one cares. It's basically a bunch of morons in Washington or arguing with each other. In the meantime, the rest of the world goes on. So if this is the case, this Goldilocks case continues, you could see the market continue a very slow grind up for the rest of the year with only 2 to 5% dips. I'd like to see a 10% dip in the summer. But, you know, if the data continues, as it has done, we may not even get that. So let's see. You will not get this view, everyone else, anywhere else, because everyone else is saying 10% dip, 25% dip, and in stream basis, 75% dip in the summer. You know, I'm data-driven, so I watch the numbers. That's all I really care about. Elias, how you doing? I haven't seen you in ages. Oil, we'll talk to oil in a second, but great to hear from you, and welcome back from Afghanistan. And thanks for the knife. I got the knife with the lapis lazuli handle. Great knife. It has a place of honor on my desk. Let's see. Elias, you base now while you're online. Okay, weekly jobless claims. Oh, Austin, okay. Weekly jobless claims, trend is still down, trend still your friend. We got a 16,000 pop last week to 357, but the major downtrend is down, and we could be trending 300,000 in weekly jobless claims. If this trend continues, that takes it to a multi-year low, multi-decade low, I think. And that also argues in favor of the Goldilocks scenario for the economy. Bonds, stagnation wins the day, can't get out of that 182.05 range. But if there's nothing else going on, trading this range, but there's just too many more attractive things to do. So I'm more of a watcher in the bond market. You know, and again, the single most important data point this year is when Ben Bernanke says he may never sell treasuries. And the more I think about this, the more likely it is that he won't ever sell any treasuries. So let's keep what they own, run into expiration, whether it's 10, 20, or 30 years, and never become a factor in the market. And that could be another thing that's supporting bonds at these ultra low yields. So that means no bond market crash. It means we just grind very slowly down over a period of years, maybe 50 basis points a year. Hedge fund longs in the bond market are close to record highs. They think the thing is going to go off to the races again. But yeah, and as long as $85 billion a month in Fed bond buying continues, I mean, to me, it's unbelievable that the Fed's buying $85 billion a month in bonds, and the stock market is at an all-time high. I mean, never happened in history, probably never will again. Creating massive liquidity, still no sign of inflation. So sell every substantial rally, if that's your inclination. And right around here, I haven't seen the Treasury yield. I'll see it in a second, but there, 10-year at 183. Boy, right around 180, 179, 178. That would be a good short play for the bond market right there. And then you could catch, say, 5 points on the short side in the TLT. So that's a nice little trade that's setting up there. Let's see. Let's take some bond questions here. REIT to sell here? Yes. In fact, all of the reach for yield plays, which include REITs, master limited partnerships, junk bonds, and muni bonds, are sells. They are all in bubble territory. I mean, junk in particular, the new issues are coming in with yields under 5%, the lowest in history. So, for the extra 200-300 basis points you're getting in these things, you're risking 10 or 20% worth of principal. Keep that in mind. That is the bubble. That is the bubble in the market now. Are basically all high yield instruments. Yeah, yes, all my MLP picks are up 15 to 20% since I recommended them 3 months ago. Yes, you should have backed up the truck and loaded it up. But that move has happened. And chasing it here, Robert, not such a great idea. Here's another good point. Obamacare is going to bring weekly jobless claims down dramatically in the next year. That is true. You never heard this in the debate over Obamacare, but the fact is that it could create as many as 5 million jobs. You bring 50 million people into the healthcare system for the first time, creates a lot of jobs, and they are domestic jobs, they're well-paid jobs. Every time I go to the doctor, which is very rarely, but I talk to everybody, say, hey, how much do you make? And these people, they go to a 2-year course at a city college. They get a job pay $60,000 to $80,000 a year. So for your non-college educated workforce, this is a great option. And 5 million is probably high. Realistically, it's probably more like 2 million, but 2 million is still 2 million. And that eventually will be what takes the unemployment rate down to the 6.5% headline rate that the Fed is targeting. That was Obama's plan from day one. That's how you get out of the jobs problem, among other things, is creating a massive national health care system. Let's see, you can bring back Goldilocks. Yes, I like Goldilocks too. Lots of Goldilocks pictures. Unfortunately, this is a family-oriented webinar, so I'm limited to which Goldilocks I'm allowed to use. Here's the TLT. Let's go through here. This kind of looks like our range, our upper range here, okay, in the TLT. Get this thing over here so I can see the prices. Yeah, so 119 to 114. There's your 5-point range. If you want to be aggressive, you want to get an instrument outside of the stock market, that's a great range to trade. That's probably worth doing. TBT, same deal, same 5-point range, but entry points more important here because the cost of carry is so high. Muni bonds, again, starting to rally back up again now that we're through the fiscal year end. Again, another high risk area. You can count on taxes to go up more, so that's another supporting factor for muni bonds. And junk, this is one of the highest risk instruments out there right now. Boy, when I started recommending this 4 years ago, and you can go back in the archives and see those recommendations. The yield on munis was 25%. Now we're at 5%. My gosh. And the yield, I think the J&K yield's under 6% now, which is the lowest it's ever. See if there's any more questions here before we move on. That is a function of our new economy. You will get to buy them cheaper. A better opportunity to buy it and see what else we have. Okay, so let's move on to the next section, which should be the equity section. Okay, the punch bowl is still full. No sign it is going to be emptied anytime soon. Drift up to the multi-year highs is incredibly bullish. That continues. April could be a repeat of March. Slow grind up, maybe 2, 3, 4% total gain in the index. Great short volatility market. Too many investors are still trapped out of the market trying to buy the dips. We never get the dips, although they are starting to get them in financials and transports, which have been the leading sectors since the beginning of the year. At 15.5 times earnings, we are dead in the middle of historic range. People can't call stocks expensive here, especially when you figure in QE, especially when you figure in zero interest rates. And do we get the overshoot in April, May? I hope so. Those existing put spreads in the SPY probably look like they're toast by now. We're getting way out of the money on those. But if we do get another nice spike up, I'm going to put on a ton of May-June put spreads and take in another 10% there. So that is the play I'm waiting to do. The only person who can end this party is Ben Bernanke, and he hasn't shown any sign whatsoever of slowing down stimulus. So until he says otherwise, you got to keep playing this thing on the long side. This is another factor which we got to consider. Another reason why you should get some multiple expansion in stocks. This is the profit margins on U.S. stocks going back 80 years. We're at an all-time high. Largely because of better management, but also outsourcing and so on. So, companies with higher profit margins deserve higher multiples. And that is what's taking us up in the market. If anything, we're going higher. We won't go lower until we get into the next recession. Notice that huge dip that we had going into 2009. Here's the Dow average. This is yesterday's chart. Hit another new high, giving it back today. Let's see. I see the S&P is now down 10 points. So yeah, and look at these charts. What we're getting here are time corrections. Not price corrections. Here's a time correction. Here's a time correction. Little bit of tiny. You need a disaster to get this thing to go down to 2%. On Monday I looked at the markets, and on Monday we entered a technical state of war with North Korea, with them threatening to launch nuclear missiles at San Francisco and at Dell headquarters in Austin, Texas. Go figure. And even the South Korean market wouldn't go down on that. The South Korean market only went down 50 basis points on that threat. So the market just doesn't believe any of this stuff. It doesn't believe the disasters coming out of Washington. It doesn't believe the ones coming in from overseas, North Korea, Italy, Cyprus, and so on. And it's become a U.S.-centric world. Everybody wants in here because this is the safe place. I mean, today's piece in the letter, half all the houses sold in Incline Village this year have been Chinese for cash. And they're not doing it for the scenery. They're doing this because this is a safe haven for them. So that is what the market is telling us. SPY, same sort of deal. This one, we're long the 145, 150 call spread. Only 12 days to expiration. 150 is all the way down here, so boy, I don't see that happening in 2 weeks. On the other hand, the 163s, they're off the chart on the upside. So we took in the money on that one too. Classic short straddle strategy. This could keep working for months. But I got to tell you, the short side's looking more attractive than the long side the closer we get to 1600. So, but from here, you could probably do like the 163, 166s for May and take in a decent amount of money. And, we probably won't get to 163 in May, and you keep the whole portfolio should probably go into that one trade. Let's see. Here's your long-term view. My view all along was that we would challenge these 13-year highs up here, but it would take many months to either succeed and break up or fail and break down. And that is what's happened every time we've been up here, is we get these 6 months of grinding markets right around all-time highs, happened back here in the dot-com boom, here at the top of the housing boom. So, what if this could go on until September? Chop back forth, 1,500, 1,600, 1,500, 1,600 for months. And of course, no one will make any money except you, because you're doing short volatility trades, you're doing put spreads on the rallies, you're doing call spreads on the dips. And you could make a ton of money just doing that every month. So we're going to keep doing that until it stops working. Once we get into the prolonged downtrend, we need some major news event to even get something big on the downside, like more than 10%. Then you put on the short plays. So, here we are right here. We're putting in a ragged long-term top over many months. That has you long the put spreads, long the call spreads. That's what the portfolio is. So, yes, and we may lose a bad news event, like we saw on United Airlines yesterday. But net, we still will make money. We took a 1% hit on United, took 2%. You've got the trade alert blip. But that's in the context of making 10% on all our remaining positions in the next 2 weeks. I look at these as portfolios, not as individual names. So using one position to hedge out the other. So as long as we're in this territory, we're just going to keep the same strategy. You should too. QQQ, this is basically the bottoming of Apple, allowing the index to start to drift up. And by the way, there's a really interesting scenario which has at least a 50-50 chance of coming true, and that's that all of the big domestic stocks that have led the market for the last 5 months go to sleep, and the technology takes off and provides the market leadership for the whole second half of the year. And that's what takes us on to further all-time highs. That is a possibility. The tech stocks have been unloved for a year. When nothing was working, everyone poured into tech because tech was growing like crazy. Now that everything is working, people are ignoring tech. That will reverse probably this year sometime, and maybe soon. So that's one reason we have the Apple call spread on. There are other tech names you can do the same thing with. So let's see if this tech move has legs. VIX dying a slow death. I still think we see single digits before this ends. We did get down to 11% last month. We could have another shot at that 11 number and lower. Apple looks like that bounce is holding. We did break the 50-day moving average, so that is positive. And it looks like we're holding again today. I don't have Apple. There it is. Yeah, it's up a bit. What are we up? Up $1.50 today. We were up like 6. So yeah, let's see if this bottom holds here. If it does, you probably want to be adding to your longs. Google taking a rest. Got a nice pop yesterday. People still love this stock. People still want it to go to 1,000. Keep bringing out new profit initiatives. The glasses are supposed to be big, so let's see. Bank of America, we're down now at this, right at the 50-day moving average. My bet is that this holds. If it doesn't, then I'm just going to have to stop out. You know, our weighted in break even on this cost is something like 11.7 with the put spread. So, you know, this will continue on an uptrend. It just depends on whether it resumes that uptrend in time for our call spread to expire in the money. So let's watch this. And it's sitting here at 11.80 as we speak. United had to pull on that. Too big of a move. We actually got down to the 28s yesterday after I sent out that alert. But looking like the 50-day will hold on this one too. You probably, you know, if we get down to that 27.80 level, I'm going to put this thing back on again. Except I'll use something like a 2024 call spread. You know, I'll go way out of the money. You know, if we get down to 27, and pick up another 1% for the month. If we get down to 27.5, then you could do the 24.1, or you could do like the, you know, 20, 25, 22 would probably make you more money. Use the 200-day moving average as your lower strike. So that would be like 23, 25, something like that makes sense. Russell, again, watch this carefully. It'll lead any downturn. Getting a bigger correction here than we are in the main index, so that's kind of interesting. Shanghai still dead in the water. Still a terrible underperforming market this year. They clamped down some new restrictions on second home purchases, so that hasn't helped. It basically took out the entire commodity space. But notice that in all these instruments that we're looking at, hard assets across the board are being punished mercilessly, and paper assets are being bid up to incredible premiums. Wherever you look, oil is bad. Precious metals are terrible. Food is terrible. Even rare earths have been terrible. It's all part of the same trade. People want, you know, in a world of improving confidence, people want out of the protection plays and they want into the leverage plays, and that's what's happening. Boy, here was your point in the DXJ. I haven't seen where it is today, but that was a great entry point there yesterday at the 50-day moving average. Again, selling off as a result of the strong yen and the BOJ meeting this week. Tesla, stock of the week, how about that? Boy, I knew this one was coming. Sales better than expected, how about that? Tesla was the top performing electric car of the entire last quarter, beating out the Volt and the Nissan Leaf. You know, people still don't understand this stock. Huge amount of that buying was short covering. A lot of hedge funds are betting this is just nothing more than a government subsidized piece of pork for California and it's going to go zero someday. But they miss the fact that they're making cars using 50% less parts than any other car ever made in history. That is huge. Plus near zero fuel cost, plus zero maintenance cost. You know, that is a game changer. And as of yesterday, they're not now offering a $500 a month lease for the S1. cost competitive with just about any other luxury car out there. So that could be huge too. Now let me get some questions here. Let's go back to the top of the equity questions. Why are the bank stocks suffering today? I think it's just a rotation out of the leadership stocks into another group. They're taking a rest. And also earnings are out next week. People want to head to the sidelines until the earnings are out, which are supposed to be pretty good. IWM, probably not a bad idea. I would do it with the spread like we've been talking about. The IWM is rolling over in advance of the SPY is a leading indicator that we may finally get a correction, even if it's just a small one. Can Italy or France be part of the party? Can they spoil the party? No, no one really cares. If anything, the weaker things get in Europe, the better it is for us because they send all their money here. Big part of the stock market rally this year was driven by capital flows out of Europe looking for a safe haven. Aren't profits heavily reverting over time? Not really. Only on a very long multi-decade view, and that doesn't take into consideration improvements in technology, which has been a big factor in the growth of margins in the last couple of years. Let's see. As far as the shorting the IWM against the SPY, that really is getting too fancy for me. I like to just keep things simple. Yes, that would certainly work in a down market. IWM goes down faster than the SPY by a margin of about 2 to 1, 1.5 to 1 in a falling market. My answer to that is short the IWM instead of the SPY. That's how I make that choice. In past years, we'll see that I've been shorting IWM on every one of these big meltdowns, and it will really work well. So you don't think EZ will correct with the market? I think the correction's already happened in BAC. That's why I'm holding on here. Typically goes to pieces, then everything goes, but as long as we're still in the uptrend on the main index, I don't think we're going to get much more of a decline in Bank of America before the market is agreeing with me. What do you think of gold here? Answer, it sucked because of the global hard asset problem that I just talked to you about. In an improving world, people don't want flight to safety instruments, and you're starting to hear the argument that the whole 12-year bull market in gold is finished, that it's going to go back to 1,000 and so on. I do think we're going to challenge that 1,500 number pretty soon, though, unless we get if Cyprus blows up, Italy blows up, and you still can't get a rally in gold, then definitely there's something wrong with it. As far as buying Tesla, I don't want to buy it here. It's run up too much. The problem about Tesla is it's a great company, but not such a great stock. It's always been too expensive. The time to buy that after the IPO when it was 18, and I did recommend people to buy it then. Let's see. If my guess on United, if you still have United, is we'll bounce off that 10-day moving 750 and rally back up again to 30. That's why it's still expired in the money, but I don't want to run that risk. Let's get, I had 10% of the portfolio in there. That's a lot to give back on a single position, so that's why I stop out when we cross these upper strikes. Let's see. Okay, so we'll move on to the next segment. Otherwise, this is going to go on till tomorrow. We're already 40 minutes into this. Okay, dollar is the new flight to safety currency, is benefiting hugely from foreign capital inflows. You know, a big chunk of that Cyprus money is coming to the U.S. That's why Russian billionaires are buying all these $100 million apartments in New York. You're also getting fewer dollar outflows from the U.S. as we buy less from Nigeria. You add these two things together, more inflows, fewer outflows, that means strong dollar. This could go on for decades. Profit taking on the euro-yen cross is causing the yen to stall. Also, there's a buy the rumor, sell the news effect. And one thing I did notice, which I should have thought about, is that we had this big sell-off in yen going to the end of their fiscal year. Since the beginning of the new fiscal year, the yen has done nothing but rally. And what's happening is Japanese companies are bringing in dividends and interest from overseas earnings. They wait till the beginning of the new year to start that. So my addition of another short in the yen last week wasn't the best time in the world. Euro is pretty much at its bottom here for the time being at 126. Weak yen will continue only with minor blips. The new BOJ governor only started officially on April 1st. Let's see if he can start delivering some results. Meantime, we want the yen to appreciate less than 2 yen more in 2 weeks, and that's a probability. That's a likelihood. Let's see. Okay. Just got invited to a Rolling Stones concert. Let's see. So here's the UUP. Notice that we are kind of levitated very high, not like the stock market is, on a flight to safety bid. That's very interesting. FXE. This is the one trade I knew was going to happen, but didn't because stocks looked even more interesting. We got our move down. I wouldn't touch it with a 10-foot pole. If anything, the euro will probably rally a little bit here, maybe back to 130 or so. Aussie dollar, sort of grinding sideways because of chunk drag. Don't want to play it there. Japanese yen, they are really starting to press the shorts. The long-term fundamentals haven't changed, so I want to run with my existing longs. Try and make money off these. Remember, they have to go all the way up to weighted average cost right around 106.80 on our break-even cost. It's right around here. 2 weeks to get there for us to lose money. All we really need to make money on this is one bit of profit taking from the long yen positions. After a move from 100 up to 106 or 105. So could get close on this one. We shall see. But for us, the goal is these all expire for us. Then we go on slap them right back again, except with much safer strikes up here at 108, 110. YCS, same deal. This one looks like it won't challenge the 56 level. That would correspond to around once with the FXY, and that would also be a good entry point for longer-term non-leveraged portfolios. Energy, Saudi America, here we come. Oil crash for China. Strong dog cap by speculative demand. 50 FX questions in here before we move on. I think Bank of Japan will come out after their meeting tomorrow and reaffirm their intention of keeping the yen weak and targeting 2% inflation. So I would keep the YCS if I'm still long. Should be well in the money anyway. As far as Apple being downgraded by Goldman, forgot it. Downgrades to market bottoms, never expected much. Okay, so let's go on with energy. No volatility this year, not enough range to trade, so we're just watching this out of interest. opening the Seaway pipeline is allowing more West Texas to get to the international market. That is causing the Brent West Texas spread to collapse. It dropped from 20 down to 13. And expanded hybrid and electrical use is having an impact. And you're seeing this in the price of gasoline, which is flatlining even worse than oil is. This could be the first time ever we'll get a spike in gasoline prices. Because there are so many hybrids out there and other energy conservation measures are taking place. So this is a map of shale plays in the U.S. And notice that about half the U.S. is sitting on top of an untapped natural gas field. Chicago's sitting right on top of one. It's called the Illinois. So this is where I started in the 90s, down here at the Barnett Shale, around Fort Worth, and I drove around there for about 5 years in a four-wheel drive, signing up oil leases and of an untapped and let's see. Okay, so this is a major game. This is why China thinks that the U.S. will be able to outcompete it in the next decade. Okay, so here's crude. Boy, there's your range right there. That is looking like about 90 to 96, $6 range. Got to get things pretty right to money on that. So I'll stand aside. Natural gas got saved by a cold winter. What happens when the cold winter ends? Answer, price goes back down. And I think we'll see that there's so much supply out there that any of these temporary price spikes is going to get overwhelmed by new supply. You pretty much count on that happening unless the gas producers form some sort of cartel, which they are trying to do. At least we're not at $2 anymore, which was their break-even cost. Here's the gasoline price, the EOD. These are the ETF on gasoline futures, and that has an incredibly narrow range, except going back to November, where it just about fell bottom after the presidential election. Copper, really looking awful here. Don't really want to touch it as long as China is weak. Looking like we will get down to the 320, 330 level. So, like with all other hard assets, like gold, oil, silver, and food, you want to stay away. Precious metals, look but don't touch. You can get good money here buying a call spread on gold, 145 to 150. But it's kind of looking scary to me. You could get another major collapse in gold. And just not interested in long side plays. So I'm going to give gold a pass. Here is a longer term chart. Go back 2 years, a little more than 2 years, and you can see this is the 1550 level, which we seem to be threatening, and below that it's 1500. Silver is even worse. Silver is very close to hitting that 3-year low at just over $26. So, and what's even worse on this, boy, look at this downturn sloping trend against support. That is not a healthy chart. So I would stay away from silver. Platinum getting support from the car industry. Palladium is the star performer here this year. That is totally driven by cars, which look like they'll hit 3 million units this year. So any precious metals questions here? LNG, well, stocks doubled, so I don't really want to do too much here other than pat myself on the back for recommending it last year. My charts have gone to sleep for me. Let me wake them up. Let's just see. Let's go to stock charts and LNG. Yeah, since I put out that piece, it's had a big sell-off for the last 2 days, 10%. Don't really want to touch it here. Again, like you're seeing in so many areas, people are taking profits on their biggest winners. That's why we got the weakness in airline, bank, and in LNG and in other sectors. So until that works its way out, I don't want to do anything here. Any other questions? Let's see. Will environments curtail these new energy sources they're trying, but eventually they don't have the factual case behind them, and the courts will rule against them. So they can slow it, but they can't stop it. And that's certainly happening in California. Of course, in California, that just means we'll get to sell our gas at higher prices. Is there a good short gas ETF? No, there isn't. There is only the long one, the UNG, and that has the worst tracking error of any ETF in the entire industry. So I would short the UNG. That's the way to go on that, or buy puts on the UNG. Looks like Bank of America is going to be weak again. Yeah. Gold stocks, even worse. Don't want to touch the gold stocks at all. They've been far and away the worst performers in the stock market. And they have a business model that hurts. Rising costs, lower selling price, not a place you want to be. Let's see. Okay, so let's move on. The ags, another disaster happened here. Good thing you found this nice little picture of corn, truckload with corn tipped over on the freeway. Shocking, USDA crop report sends futures limit down. It's classic out of the blue type move on an ag contract. That's why I hate having positions in the eggs. Prior to these big crop reports, you never know which way they're going to go. Corn in storage got revised up 10%. That's a huge move. Demand for methanol fermenters is collapsing. Again, partly because of the weak demand for gasoline. So, we're starting to get low enough in corn where you might want to consider a long play in case we get out of the red hot summer like we did the last couple of years. Down to 36 on corn, that becomes really tempting long. So keep watching that. The play here, we're shorts all the way along. I only did one because liquidity options isn't very good. So DDA commodities index even worse. This includes stocks. So again, this is suggesting breakdown to new lows. So I'll just kind of watch from afar while this unfolds. Real estate boom continues. January Case and Schiller up 8.1. All the data is positive, but the market is changing. We got our first increase in inventories in a year. First-time home buyers are only 30% of the market. District sales are still 30% of the market, and that is still hedge fund and institutional buying for cash. So it's not your father's real estate market. However, prices still seem to be going up. Here is the Schiller data updated, and this shows very strong uptrend. And many parts of the countries, like San Francisco, have already recovered their all-time highs, even though the national statistics haven't. Some places like Chicago, New York, are kind of dead in the water right now. This is the housing starts trend, and this is the major driver behind the stock prices of the home builders. That's looking very good. And permits, also new construction, also looking green. So again, you don't want to touch the stocks. They run way too much. This is the ITB, the Home Construction Dow Index. And the risk here is very high, so I don't want to get involved at all. Let's see if we have any questions here. Okay, so let me finish this thing up so we can keep it small enough so we post it on the website. Sell rallies under a 180 yield, commodities stand aside. Nothing to do there. Currency, sell yen on any rallies, and this is a nice rally. To those who missed the yen, here's a great chance to get back in. Too late to do anything on the euro. Precious metals stand aside, wait for a rebirth, and burden of proof is on the market for that one to start performing. Volatility still dead. The eggs wait for the crash to work its way through the system before you consider a long play real estate too late to touch. So that's pretty much it for the day. Please go to my website, buy the tickets for the lunches. The next webinar is on April 17th, and I'll take one or two final questions, Karen. Okay. Okay. Emerging markets. There's a big sort of separation going on within the emerging market space. The EEM has lagged the U.S., but individual markets like Thailand, Philippines, Indonesia have been doing really well. China has been doing really bad. So it's become much more of a stock pickers market. I think if the U.S. starts to talk about emerging markets are another area where you could see another big rotation going in there. So watch that. Watch the area. I'm watching emerging markets, but I just haven't seen anything there that can beat the U.S. so far. Let's see, Iran's nuclear program will go nowhere, so that's mostly a media concoction. I wouldn't worry about it. Thank you for the compliments, Mason. Glad you like the webinars. I just do it to help people make money, get some satisfaction out of life for myself. JJG is a good long ag play, and I'll definitely be watching that, for a summer play, Lola. Let's see. Yeah, Craig, that may go away. Could work again this year, although it may not be as dramatic as in past years. In doing spreads out of money, you don't need things to be dramatic. You can still make 5% a month doing it. So that's pretty much it. Thank you for joining me today. Have any other questions, just send them to customer support, and they will forward to me, and I will answer them to the best of my abilities. In the meantime, this is John Thomas signing off. Good luck and good trading.